Good afternoon, everyone, and thank you for joining us today for our Impacts of Climate Change Data on Existing and New Loans webinar. My name is Michelle Hauser, and I am the Community and Events Manager for USEReady. Before I introduce you to our panel today, allow me just a moment to share a few housekeeping items. If at any time you experience a technical issue, please send a chat message to USEReady webinar, and I will do my best to assist. We encourage you to share any questions that you may have with our panelists using the Q&A feature, and we will do our best to answer any submitted questions during our program. Should we be unable to answer your questions due to time constraints, we will reach out at the conclusion of the program. I am joined today by panelist Dan Davidson, a senior client partner with over 20 years of experience helping banks get the full value of their data, analytics, and digital transformation programs. Personally, Dan has firsthand experience with the impact of climate change as a volunteer firefighter, often responding to natural disaster emergencies. Today's other featured panelist is Solutions Principal Caitlyn Garger, a visual analytics SME with experience working with large banks and financial institutions in developing and reimagining their data, analytics, and visualization. Turning it over to you, Dan.
Thanks, Michelle. Today, we're going to talk about a couple of things and leave some time for Q&A at the end. First, we're going to talk about the impact of climate change on loans, whether they're in your portfolio or you're servicing them. It's important to pay attention. Then we're going to talk about and demonstrate a climate change impact dashboard that Caitlyn will demonstrate and has created herself. So ESG has become a hot topic across all industries, especially banking. The focus of this presentation is going to be on the first letter E, environmental. And for banks, there are a couple of lenses for evaluating environmental risks. The first one is the environmental impact of the banks and their customers' activities themselves. So it could be the carbon footprint and so on. Environmental impact on the bank's assets and collateral, through natural disasters is another area of focus for banks. And this is the one that we're going to focus on today. So I'm sure you're all here and you're aware of the magnitude of the risk on your portfolios, on the loans that your bank has issued. But let's just put it in perspective. So last year, natural disasters cost over $268 billion in economic losses, and about almost half of that were uninsured losses. This is the second year in a row where that number hit over 200 billion. And the frequency, severity, and extent of natural disasters are on the rise in the US and worldwide. Something that I saw that was interesting is that about 90% of all counties in the United States have already suffered a major disaster since 2011. So these facts kind of give you a perspective of, these are big losses and big risks for banks to consider. So some other factoids here. A lot of these have to do with flooding as an example. So between 58 to 86 million people, more people live in floodplains around the world between 2000 and 2015. That's an increase of about 20 to 24% of the proportion of global population. And this is not only being driven by climate change, but it's also has to do with urbanization. More and more people are moving into urbanized areas that happen to be in some of the most hazardous floodplain areas. So even if you are saying that climate risk isn't increasing, more and more people and more assets are moving towards the areas where climate risk is a greater risk today. And we see that sea levels continue to rise, damages due to storm surges and flooding also increase. The other interesting thing that we noticed is that FEMA flood maps do not accurately depict climate change. So a 2020 study estimated that 14.6 million properties are at risk compared to the 8.7 million properties that FEMA has in their flood zones. So the risk might actually be a lot greater than you think. A lot of our clients, our banking clients, have requirements on having flood insurance in flood zones, but some of them don't have requirements for flood insurance in flood zones that are outside the FEMA maps, but other agencies predict that there could be flooding there. So chief risk officers at banks are becoming concerned about climate risk as well. According to a global bank risk management survey, environmental risk has been the #3 priority for chief risk officers for the past couple of years. And this has grown a lot. I think if you look back at that survey several years ago, climate risk or environmental risk wouldn't have even been on the list. And now it's the #3 risk. 58% of CROs at GSIBs opted for environmental risk as a top 5 focal point. On a 5-year timeline, 65% of chief risk officers recognize climate risk as the most important concern. And over the next 36 months, chief risk officers expect ESG and climate risk to see the greatest increase in priority. Also, 48% of CROs and 75% of GSIB CROs have mentioned building out climate risk teams. So, obviously banking is a highly regulated industry. And even on this topic, the regulators have taken notice. And the OCC has noted the weaknesses in how banks identify, measure, monitor, and control potential physical and transition risks associated with climate risk. So the regulators are starting to get concerned, which means they'll start asking questions of banks soon, if not already. So there are a couple of risks, 2 different types of risks that the prior statement calls out. They call out both physical risks and transition risks. And it's important to note the difference. Physical risks are probably more what you would think of as the risks today due to climate change. So it could be the increasing risks of major storms, increasing risks of flooding, of wind, and many different other perils. So, if there's a hurricane, the risk is that some of the buildings will be damaged, some of the buildings will be underinsured, some of the businesses won't have business continuity insurance, or they just won't be able to continue operating as they have in the past, right? So those are some of the more obvious ones. There's also another type of risk called transition risk, and that one's a little bit less obvious. Transition risk is how industries and economics will change as a result of climate change. So, for example, a lot of communities are now requiring that once a building is sold, if it's near a flood zone, that the building becomes elevated. Now that could impact the value of the collateral just because of a policy change. Certain businesses won't be around anymore because of climate change. So those are some of the more transition risks as climate risk becomes more impactful, as policies change. There could be sort of a second order effect of on property values and the risks to loans. So the regulators have established general principles to provide guidance to banks as they develop their capabilities. They provide guidance on governance, policies, procedures, and limits. They provide guidance on strategic planning and risk management. But the 2 that we're going to focus on today really have to do with data, risk measurement and reporting, and scenario analysis. When I think through on this page where banks are in their journey to measuring and handling climate risk, I think a lot of them have been very focused around the physical risks, the easily measured risks. And they're starting to ask questions and starting to model out and think about the transition risk. In terms of the principles that have been outlined by the regulators, I think I've seen a lot of our clients start to talk about governance, some policies and procedures and limits. And probably the most obvious example is one that's probably started to take shape years ago, or probably after Hurricane Sandy. I've started to see more and more banks really buttoning up on their flood insurance requirements for homeowners that have mortgages with them. But we're starting to see more and more policies, procedures, and limits coming to play here. We've seen some strategic planning, and we started to see some risk management. I've heard a lot of our clients start to talk about what are their risk tolerances around climate risk. But what I'm not seeing as much is real reporting around data, risk measurement and reporting, as well as scenario analysis. So I want to turn it over to Caitlyn to give us a demonstration of the impact dashboard that she had created that starts to show how banks can monitor this Q risk. Over to you, Caitlyn.
Thank you, Dan. So now that we have the context as to why climate change analysis and reporting is really critical, what we're going to do is we're going to see and kind of demo through a potential solution as to how you can combine climate change data with your own organization's internal data to gather information about those potential risks, maybe across properties in a portfolio. So what I'm showing now is a climate change loan portfolio risk dashboard. This dashboard provides an overview of how the varying natural perils may affect properties in an organization's loan portfolio. A peril is an event, I think Dan might have mentioned this, but it can cause damage or loss to a property, and some of those are included here in this dashboard, things like fire, flooding, or sea level rise. Now, whether or not a property is at risk for damage or loss depends on the result of a climate change scenario or model. Climate scenarios capture the relationship between human choices, emissions, concentrations, and temperature change. Historically, we think of FEMA flood maps or FEMA risk maps, but there are many other organizations out there that are providing weather intelligence data, like Jupiter Intelligence or Earth Networks. So we know that it's basically impossible to perfectly model the Earth's climate system and to accurately project how our climate is going to change in the future, and therefore, in our case, how our properties and our portfolio might be affected. So what we're going to do is basically lay out, and what we can only do, because we cannot perfectly model the Earth system, is to lay out the different scenarios that are possible and model our actions and decisions to best prevent that catastrophic loss or damage. This dashboard I'm showing here today is built using synthesized data, which means that this data was intentionally created to mimic high-level trends with regards to climate changes that we're seeing and the trends that we're seeing, along with present some basic KPI information that maybe a financial institution executive or manager would like to analyze. Now, because climate change can be a very complex topic and also confusing, I'm going to provide an overview of how to interact with and use the dashboard before we get into our main use case here. So up top, we see a legend that lies showing here the different colors associated with each risk type or risk rating. So high risk, moderate, and low can all be assigned to a property depending on the combination of a scenario and the peril that you're looking at. Below the legend are your filters and parameters. You can change the scenario or model that your dashboard is reflecting with this first dropdown, and the scenarios range from best to worst case scenario. Right next to that is the choose property status filter. In our case, active properties are those that are owned by our institution, and inactive properties are those that have been sold but not yet legally transferred. So if something were to happen to those properties, we would still be legally responsible for the loss. Right next to that is the option to filter by risk rating. Again, like I said before, risk rating ratings are assigned to each portfolio or each property in the portfolio based on the scenario and peril combination. An example, maybe drought for a specific location in an average case gets a risk rating of low, but for another location, it's high. And the last filter we have here on the right is just a filter by region, so we can drill down into a specific area of the United States in our case. Now, this dashboard consists of 4 main focus areas or visuals, and on the top left, we see the key metrics for our portfolio. These give the user a little bit of a look inside the size of their portfolio and how much of that portfolio is at risk. So maybe I find through my analysis that maybe a specific region or a specific property type takes up 40% of my outstanding balance, but only maybe 15% of my number of loans. So why is such a small subset of loans attributed to such a large percent of my outstanding balance? I'd probably want to look or investigate further into that smaller subset of loans. To the right, I see a stacked bar chart showing me damage amounts across our different natural perils. Each bar is split by risk rating. This allows us to really see what perils we need to focus on or what we need to watch out for. In the case that maybe a property is at high risk for a majority, or hopefully not, but all of these perils, you might want to get that off your books or see what you can do. The bottom half of the dashboard is actually split by a title section, asking the user to choose a specific peril. So any of those charts below, that map and the stacked bar chart to the right, are dependent on the peril that you choose in this title section. The map on the lower left-hand side has a circle for each postal code and risk rating combination, as individual loans in our use case here have been aggregated up to the postal code level. Each size on this map just denotes the possible amount of damage caused by that chosen peril. Now, in a real life use case and using your own organization's data, we would probably make this map individual property loan level, where we could even maybe link it out to a satellite imagery of, of the property to get real down into the details. To the bottom right is a stacked bar chart showing the damage amount across the risk ratings and property types. And what I can see here is I have different property types, about 5 in our use case. And maybe depending on how our properties are distributed across the US, maybe some property types are at higher risk than others. It really just depends on where they're located. Now, this entire dashboard is meant to be interactive. As I hover over any mark, you might have seen already as I've been moving my mouse, additional information or context comes up as I hover over marks. And if I do want to kind of drill in further to any mark, I can click and it will filter the rest of the dashboard. So we'll see that in a moment. All right, so now that we've gone through the layout and basic functionality of the dashboard, I really want to see, how can this dashboard help me find sort of that needle in the haystack? Where are my outliers? What action can I take to mitigate my risk? How can I go from a large group of loans to, something that I can actually take action on? Maybe there's a few loans that I really need to focus on in my analysis. So just before I even change any filters, I see that I have about $14 billion in outstanding balance across about 6,000 different loans. If I'm looking right now at average case scenario, maybe across my different perils, what's really drawing my attention is I have a pretty high risk for sea level rise and wildfire across most of my loans. Now, I personally am of the mindset, prepare for the worst and hope for the best. So I'm going to actually change this scenario to worst case scenario. As I make that change, you can see the rest or most of my dashboard changes to reflect that new model chosen. I can see on the right side too, that sea level rise, there's a lot in high risk now that I've chosen worst case scenario. And overall, sea level rise is attributing to possible $8.5 billion in damage. And that's more than half of my outstanding balance. So I probably want to look a little bit further into this. So what I'm going to do is I'm going to come down to the second half of the dashboard and I'm going to choose sea level rise. So now that I've done that, I can see that, where my properties are located, where it's high risk, right? I see some properties, in pockets of San Francisco, LA, San Diego, some around Houston, of course, some around New York and Long Island area. But what really is drawing my attention is this larger mark in Southern Florida, and more specifically Miami. The reason why it's drawing my attention, not because of its location, but because why are my other dots in Southern Florida not as large? So what I'm going to do is I'm going to click on this mark for Miami, Florida, and see what makes up that mark. So it looks like it's about 0.68 billion in outstanding balance across 33 different loans. These loans look to be high risk for extreme heat, sea level rise, and wind, right? So that's makes sense to me. But what really draws my attention is the distribution of what types or what property types I'm seeing across these 33 loans. It looks like I have a large amount in hotels and motels. So I'm actually going to click on that little icon to filter the rest of my dashboard here. And it looks like I only have 12 hotel or motel loans, makes up about 0.19% of my overall portfolio. But what is interesting is that those 12 loans make up almost 5% of my outstanding balance. So that's a small subset of loans making a big impact or bigger impact on my outstanding balance of my overall portfolio. So from here, I probably want to look into these loans. What large loans do we have? Why is there still such a large amount, remaining or outstanding here? So what I want to do is I want to get a list of these 12 loans, and I can easily do this. All I need to do is I'm going to hover over this little mark here on the map, go over to this view data icon, and I can see a list, if I go to full data, of those 12 loans. I can get those loan IDs, I can see the damage amount, original loan balance, and remaining loan balance as well. And I can even sort it in here if I want. And I can see I have a loan on my books that's almost 200 million in remaining balance. So probably, again, something I want to look into. I've just in a couple minutes gone from over 6,000 loans down to 12, right? The idea of combining that climate change scenario analysis, that type of data with my internal data, I've been able to get to my insight much quicker, and I have actionable insight. And this dashboard is just, one way I can visualize my data. Possibilities for this are really endless. I could build out multiple dashboards, maybe a loan lookup analysis dashboard, maybe a comparison of regional loans, whatever it may be, whatever questions I'm trying to answer. And I think, like Dan said before, climate change is no longer a worry for the far off future. It's here now. It's going to continue to be an issue for a long time. So it's definitely a priority to make this critical reporting happen now. And you might be wondering, all this is great. Like, what can I do though? What kind of next step can I take with my own data? How can I visualize my own data? So what's great is you can actually head over to the Tableau Exchange, which is it has a collection of dashboard accelerators, extensions, and connectors to help you in your analytics journey. And you can use the link provided on the screen right here to navigate straight to the dashboard that I just demoed. And you can download that workbook very easily using that download button. There's also a video instruction guide if anyone needs a little bit of a refresher of how to use the dashboard. Now, with that, I want to open the floor up for any questions that we may have. Michelle, do we have any questions in queue, or Dan, did you see any come in?
No, not yet. But what I really was struck by is sort of the interactivity and how you were able to really drill down. I know for the demo that you showed today, it was mostly made up data, right? Obviously, we can't use our clients' data and present it here. But you and I, when we were interacting with the Tableau dashboard at the client site, we saw some interesting things, right? We were able to look at properties in flood zones that didn't have flood insurance, and we said, well, that doesn't make any sense, and we pointed it out to the client. Mm-hmm. And he dug deeper, and he found out that those properties were they were just properties that didn't have a building on it, right? So less potential damage from a flood. But we also looked at the properties that were not in FEMA flood zones, but were in sort of the scenario based, the Jupiter data in this case, flood zones. And we saw that some of them, there were a lot of properties there that didn't have flood insurance. And so that was eye-opening for our clients. Mm-hmm. So the interactivity is really amazing. And when you can overlay additional data that your bank might have, you can find even more insights than what we were able to show here. I know there are no questions still, but feel free to use the Q&A button at the bottom of Zoom here. But in the meantime, we got some questions ahead of time. You talked about FEMA flood maps and Jupiter data. What are some other sources of information that you can tap for this?
I think, there are a lot of different organizations that their main purpose is, weather intelligence data. So, Jupiter Intelligence and Earth Networks, like I had mentioned, are just two. There's probably, dozens and dozens of them. And they all you can compare them to FEMA, right? And I think with what you had said earlier with the magnitude of risk, some of the factoids is, FEMA cutting it, right? Is FEMA enough when you're looking at the risk? So it might be good to get something like Jupiter Intelligence or something like that, where their sole focus is that climate change scenario data, and overlay that. So, and by no means, no internal bank team is most likely going to create their own climate change data. They're focused on their internal data and how it's going to be affected by that climate change data.
Yeah, I got one in the chat here. I think it was directed at the panelists. They see that we built it on Tableau, but can you build something like this in Power BI or some other tools?
Of course, yeah. Visualization here is really the main focus. I mean, you can do visualization with most tools, and obviously BI tools are meant for that. So Tableau, Power BI, whatever your firm is using, really just depends on what sort of visualization you want to do. If it's focusing on mapping or focusing on machine learning or focusing, there's pros and cons to each, but most important piece is really to gather the information needed for analysis and to visualize it. Because like you saw, couple minutes, and I went from 6,000 isn't a lot, but 6,000 down to 12 in a few minutes, few clicks.
Right. Now, what about the difference between static and live data? Sort of, and versus projected data, right? So I think we were talking to a client, and he's like, I can put on a map where there's like a wildfire going on. I could see if any of the properties are in the path of a hurricane, but there's also projected data, and how do you see banks using that?
Just obviously there's so many different ways that you can use it. I think one of the things that comes to mind first is for live data or real time, it's more along, I mean, personally, I would probably want it to be, customer outreach, right? Think about like Sandy and people not having power or not having access to banks, where's their local most, the closest bank to them that's open or can help them out, or what other options may they have. But hopefully in the scenario where you're using the projections, you're prepared for something like that, right? It's in the future, talking about more of like if we're covered by insurance, or where's our risk overall. But I guess it depends too, just what team is using it within the bank, what financial institution, what their focus is.
Yeah, we got a question here, Caitlyn. Could these insights be embedded into a loan app platform for underwriters to be alerted while in the process of underwriting?
Oh, 100%. I mean, embedded analytics is a huge thing. So it's definitely possible to embed your analytics solutions in things like customer-facing portals or publicly available URLs.
Yeah. Now, who did you work with at the client site? In other words, who's responsible at our client sites for building out these types of tools? So, for example, what skill sets did they need?
Mm-hmm. I think it's a very good question. I think it's honestly ever changing, and people are still trying to figure out, just because climate change reporting is still new to some institutions. I've worked personally with the credit risk teams and commercial real estate teams for one of the larger financial institutions. And even within each team, I think it's more of a group effort of you have the skill set of data engineers, you have the skill set of data analysts, and then you have business bringing in, what questions we're actually, interested in, because there's so many different ways that you can look at the data. It's probably one of the more gray areas of analysis that's out there. So I think it's ever changing, and that's why it's super important as well to kind of get a hold of it quicker, sooner rather than later.
Let's try and answer one more question that was submitted. In the data preparation stage, can you talk about granularity of the external data that we brought in? So for example, is it at a zip code level or a loan level or industry level? I think the data that you showed was more zip code level, but that's because we were working with sort of demo data, not real live data. But talk about the granularity that you have.
Yeah, for sure. And I think that also, I think gets down to the very nitty gritty of latitude and longitude, right? I can get down to specific properties. I mean, what I'm doing with the client is individual property location. So I don't think it gets any more granular than that. Just for our demo here, it was zip code, just because it was, aggregated and and anonymized as that synthesized data. But Jupyter, like Jupyter Intelligence or Earth Networks, it's very, very granular information that you can bring in. It really just depends on, are you creating an executive view with very high level, or more of a analysis or detailed view where you're getting down to individual properties.
Great. I think we're out of time, but you have our contact information in front of you, so feel free to reach out to us at any time if you have additional questions, and we'd love to continue the conversation and answer those questions. So thank you all for joining, and thanks for the questions. We definitely enjoyed this session.
Thank you. Thank you, everyone.